From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, a weather-impaired jobs report shows payrolls fall and wage growth surge. The shortlist for the next Fed chair reaches the president's desk. Warsh, Yellen, Cohn and Powell are all in the running. And the divide between Madrid and Barcelona continues to grow, sending Spanish bonds lower, then much lower. We begin with the big issue. Does wage growth surging rubber stamp the Fed's next move?
This is confirmation that we are getting real wage growth.
The 2.9% wage growth that's the headline.
I think that's good for American workers.
You're looking at the wage growth and you're looking at the unemployment number, which is the real bright news here.
Remember, Janet Yellen has said that in a healthy labor market, wage growth is between 3% and 4%. So we're just about there.
As long as wages begin to rise towards 3%, they certainly are. I think the Fed is slam dunk in terms of raising rates in December.
This confirms a story that has been permeating in the market, which is the data is strong enough and the Fed has said that they're going to tighten, and therefore December is pretty much in the bag.
I think people are going to rightly interpret that the Fed can move. They're going to go in December. They're going to go, we think, 2 to 3 times next year.
Joining me around the table in New York is Oksana Aronov, an alternative fixed income strategist at JPMorgan Asset Management. George Goncalves, head of America's fixed income strategy at Nomura Securities International. Plus, coming to us from Edinburgh is Luke Hickmore, senior investment manager at Aberdeen Standard Investments. Guys, I want to begin with the payrolls report and just whip through the estimates and the numbers themselves. The estimate was 80,000. The number was negative 33. The unemployment rate grinded lower to 4.2%, but wage growth came in hot, 0.5% versus an estimate of 0.3 month on month, and almost 3 percentage points on the year-on-year figure. George, looking at those numbers, it was a weather-impaired jobs report. We were expecting that on the headline number, but there was some excitement around wage growth. Was that weather-impaired too?
There's a slight impact from weather from there, but we do think that there was some calendar quirks that are also boosting up the number. But by and large, it is heading in the right direction. I think that the earlier comments that you kind of scrolled through, I do think the markets have been waiting for this, and I do think that even if we get weaker kind of growth numbers, but if we get wage pressures and general inflation turning higher, then the fixed income market's going to get more defensive. Interested in
the reaction in the market. Treasury yields higher by 4 or 5 basis points. We've reversed that move over the hours afterwards. Oksana, what do you make of the intraday activity around the jobs number itself?
Look, this was a strong jobs number, no question about it. The unemployment rate lowest in 16 years, underemployment rate lowest in 10 years. Participation rate is up, wage growth is up. There is no question about it. We have to stop interpreting good news as bad news and bad news as bad news. That can't just feed on itself incessantly. But certainly, Treasuries at 2.4, became an interesting buying opportunity, I'm sure, for some participants out there. The question is, what is the pace at which the Fed will move, right? So the next move towards the end of the year seems to be in the bag at this point. What happens after that? And can this structurally untested market, which we'll talk about hopefully more later, really handle that?
Well, Luke, let's cross over to you very quickly and just talk about as to why the markets really stopped trading on the wage growth figure after getting excited for about 5 minutes after the number dropped.
I think this may be to do with the fact that we saw it ahead with the ADP yesterday, that the employment growth is still going on in the US, and everybody knows the non-farm payroll difficulties versus the household survey difficulties. So, as per normal with non-farm day, we get a bit of volatility around the number, everybody sits back, thinks about it, and we get back to normal again. Yields are going to go higher over the long term, but just for now, I think people are just going to digest the weather report that we've had.
It is a weather report and not a jobs report. It seems to be the takeaway for so many people. I want to get to the positioning story, Oksana. You guys over at JPMorgan did your client survey, and the respondents showed a huge short position in treasuries. How critical is that to some of the price action we're seeing on the screen?
So I actually want to take a bit of a different view on this, because you hear and read a lot about these short positions, being supposedly largest in multi-year periods. But let's kind of debunk the myth here. Where is all of the money in fixed income? It is in traditional. purely interest rate driven risk. Trillions and trillions and trillions of dollars are on that side of the boat as yields have continued to come down and down and down, and people are getting paid less and less and less for that risk, but they just can't get enough of it, apparently. And also, let's make no mistake about the fact that a lot of the price action within treasuries, within sovereigns in general, has been driven by central banks. The relationship between the increase in central bank balance sheets and what yields have done over the last, 8, 9, 10 years is an almost one-for-one relationship. So this idea that, there are these enormous institutional buyers that are going to come in and provide demand for when, rates do start to firm up on the path of normalization, I simply don't think that's going to hold up.
And George, you've folded all of that in around work of the term premium as well, and looking at what's happening with the nominal 10-year Treasury yield and ultimately what hasn't been happening with the term premium.
That's right. So we can't be remiss with central bank liquidity as just kind of described, and I think that still is kind of holding and anchoring us down lower than fundamentals. And as you can see, when you're looking at 10-year rates, typically track term premium. There's been kind of a disconnect here. I mean, the Fed is also raising short-term rates, so rates are rising overall. But we do think that as the Fed's balance sheet unwinds and eventually the ECB tapers, that this kind of flow that supported sovereign paper is going to go away.
Concentration, you touched on it. I'm going to allow you to sort of elaborate on it. How much of a problem that may well be in the coming years?
So concentration is, I think, a really significant problem, whether you look at the concentration of interest rate risk in portfolios generally and how that concentration is achieved. Because in the retail market, for example, not only in the retail market, to some extent in the institutional market as well, it is achieved through ETFs, which are meant to be instantaneously liquid, but in the case of fixed income are tied to an inherently illiquid instrument, a bond. And so what you see when you look at the largest ETFs, for example, across all the sectors, the general aggregate, the corporates, high yield, the is you have these ETFs with, let's say, 1,000 different holders, but when you look at the top 10, they tend to control 30 to 50% of each one of those ETFs, which should really give everyone a pause when you consider the fact that the top 5 corporate bond ETFs, for example, account for more than double the inventory that the street is currently carrying. How is that going to work in terms of the dynamics around the possible, reflation trade, let's call it?
Luke, your thoughts on that subject?
Yeah, look, there's been a lot of money flowing into ETFs. If you look at the fund flows, the majority of it, certainly much more than active money, has been flowing into ETFs. In a way, as an active fund manager, I'm kind of a little bit nervous about it, and kind of a little bit happy about it. There are a lot of people who are going to get very upset in ETFs as we go through what is likely to be 2 to 3 years of quite heavy volatility in yields and in credit spreads as well, that actually should be in active money, not in passive money, through what could be a pretty tough time. Now, I wish they didn't have to learn that lesson, but it feels that's what they're going to have to go through.
Just thinking about the next couple of years, Luke's talking about a period of volatility. I'm looking ahead to 2018 and wondering, how on earth can we predict anything when we don't know who's going to be running the Federal Reserve? Now, we know the president's got a short list, and we know on the short list there's a few names, and they go something like Yellen, Walsh, Cohn, Powell, and on some people's short list you can throw in Taylor as well. Is this a market that's ready for any one of those individuals, George?
So obviously, with Chair Yellen, we would have continuity, so the markets are prepared for that, and to a certain extent, even Jerome Powell as well would be kind of viewed as a kind of a Yellen proxy. But for the other two, I think that we do think that a Kevin Warsh would be not necessarily volatile by nature, but introducing new ideas around policy, around how to interpret data, and just his views around the balance sheet, which was a big sticking issue for one of the reasons why some in the markets think he actually resigned. So this idea that the Fed's on this kind of cruise control balance sheet unwind, what if they actually go faster because inflation comes back? It does introduce volatility.
Just to wrap it up with yes or no, if Kevin Warsh drops across the Bloomberg terminal one morning and it says he's been nominated as Fed chair, is that a sell on treasuries?
The treasuries will probably, there will be volatility in treasuries. Treasuries will probably move up. I would just add that, there's a lot of conversation around, which one of these is going to get the nod. Yeah. I think if you look at it from the standpoint of who is most aligned with the administration's growth goal and deregulation agenda, I think Kevin Warsh definitely has a pretty strong case.
You think he does?
I think he does have a pretty strong case in that particular realm. And, are the markets pricing that in? Not likely at this point.
Oksana Aronov from JPMorgan Asset Management staying with us alongside George Goncalves from Nomura Securities International and Luke Hickmore at Aberdeen Standard Investments. Up next on this programme, the auction block. Amid tension in Spain, the country very much needed to get away its bond offering earlier this week. We'll bring you the results. That's next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I want to head to the auction block now, where we start with corporates and focus in on a little bit more of energy. Thanks to offering this week from Transocean Energy Transfer Equity and Goldport, energy companies are returning to credit markets at the fastest pace in 3 years, with bankruptcies falling, oil stabilising and companies facing more than $70 billion of debt maturing in 2019. In sovereigns, Abu Dhabi's $10 billion sale and Jordan's $1 billion transaction followed Saudi Arabia's $12.5 billion issue last week. The borrowing binge pushes sales from the Middle East and North Africa to a record $89 billion this year. And the big headliner this week was in Spain, a sale of 3.2 billion euros of 5-year debt. The yield of 53 basis points is more than double that on last month's Spanish sale of similar debt, sending demand to the highest level of interest in this maturity for months. Still with us is Oksana Aronov from JPMorgan Asset Management and George Goncalves from Nomura Securities International. Luke Hickmore at Aberdeen Standard Investments joins us as well. Luke, let's just dig into Europe very quickly. European politics is reasserting itself, and this time it's Spain and Madrid and a divide opening up, and I'm trying to gauge whether that stays a Spain story or whether it bleeds through to the rest of the periphery as well.
I think it's a Spain story through and through. I really don't think you can start reading this through to the other GIPs, as we used to call them during the middle of the sovereign crisis, Greece, Italy and Portugal. I suppose there's an outside risk if Catalonia continues to cause problems. We've got an Italian election coming up probably early next year, then that may spill over into that as well. But right now, right here, this is all about Catalonia in Spain.
I caught up with Rick Reeder of BlackRock a little bit earlier. This is what he had to say on Spanish bonds. Take a listen to this.
Away from this piece of news, Spanish growth and employment data is arguably the best in Europe. I mean, it has been heretofore the best story in Europe. Now you've got a window that maybe you could buy it a bit cheaper.
Rick Reeder is a buyer, Oksana, and has been a buyer as they've backed up. Are you a buyer?
Not a buyer. I'm astounded, frankly, that we still have Spanish debt hanging out in the 1.7s. I mean, no one wanted this stuff in double digits 5-6 years ago. Frankly, Rick Reeder's comments there support the fact that if growth continues to accelerate, then bonds should be reflecting that in terms of pricing and growth, inflation, et cetera. But here's the power of artificial price setting by central banks, right? So that's what they're capable of doing, keeping a lid on that interest rate level.
If you just look at where spreads have been throughout the year so far and over the last 12 months, Italy has blown out a whole lot wider than Spain has. And what you're going to see on the screen in just a moment is the basis point move over the year in terms of spread. And what you'll see is Italy is blown out to 40 basis points. That's change. 40 basis points change over the last 12 months compared to what we've seen in Spain. And I just wonder, Luke, to come back to you, whether Italy is the real story and Spain's just kind of the appetizer to what might be coming out of Europe in the next 12 months.
I'm afraid it's an even bigger story than that. It's about credit markets generally. Do you really want to take a lot more risk in a market that's getting more and more asymmetric? The downside's getting bigger and bigger here. And when you're thinking about Spain and Italy and the peripheral markets generally, you're loading up the risk. Right at this stage of the cycle, that's not somewhere I want to be. I want to be in companies that I can understand where they're going. Now, that means you're cautious about Spanish companies all of a sudden. You're cautious about Italian companies. But that suits a more cautious stance anyway.
George, if you're over an ECB HQ in Frankfurt, Germany, and you're sitting at the top floor and you're Mario Draghi, what are you thinking of what's happened in Spain over the last week or so? I
think you're looking across just overall European rates, and you're thinking that obviously they've been such a heavy force in markets to her point, and I think that there's definitely look, I think we've fallen into this trap of relative value comparisons, and your chart of showing just a spread change, but the overall levels are low, and if we are going to see growth, and he should be wanting to see rates rise for the right reasons.
I would just add one thing. We are sitting here with U.S. cash about to hit 1.5% potentially. Why does anyone want to buy Spain at 1.7?
Apparently they do, Oksana. So why do you think they do?
And I think it's again, it's the power of artificial price setting by the ECB. That's where most of that demand is coming from. It's the ECB put.
Oksana, how difficult is it going to be with that in mind for the ECB to pull out? Let's pretend we didn't have ECB QE over the last week or so. What kind of movement we could have seen in the bond market? How difficult will it be for them to take a step back?
How difficult will it be for the ECB to take a step back? I mean, they're going to react to the economic right, picture on the ground, which continues to strengthen in Europe and specifically Spain. Spain has been mentioned, one of the stronger areas. So if the Fed continues on their trajectory, that gives the ECB some cover, and they have certainly made comments in their comments very clear that they are headed in that direction.
Luke, in terms of the options on the table for the European Central Bank as they look to change their quantitative easing policy, there seems to be two broad options that the Governing Council are kind of tussling over and debating. One is you can drop QE by, say, 20 billion and extend for a shorter duration of time, or you can drop by a lot more and extend the duration by a lot more. So QE can run longer but at a smaller rate, or you can run at a bigger rate and have QE go a little bit shorter. Given the politics, do you think the weight of interest from the Governing Council might actually be to extend it as long as possible?
Yeah, it's got to be, doesn't it? We've got Catalonia now, as I say, we've got Italy coming up, and we've got Austria still bubbling away. We haven't even got a fully formed government in the Netherlands yet. So, you know, I would have thought Mario Draghi would take his time right at this moment, but that doesn't mean he doesn't accelerate later. This isn't a single two-option game. There's nothing wrong with him getting into next year when things may have calmed down and actually accelerated. But I tend to agree, take longer now, be more cautious now. They've been involved in every new issue. That makes a massive difference when they withdraw.
I think for a lot of people it's kind of scary too. Everyone's sticking with us. Oksana Aronov from JPMorgan Asset Management, George Goncalves from Nomura Securities International, and Luke Hickmore at Aberdeen Standard Investments. I want to get you a market checker on where treasuries have been this week. 2s, 10s and 30s. Yields grinding just that little bit higher. Up 2 basis points on a 2-year, up 3 basis points on the 10-year, and up 3 on a 30-year as well. Still ahead, the final spread. The week ahead featuring US bank earnings and details on their fixed income trading groups. That's one thing to watch next week. This is Bloomberg Real Yield. This is Bloomberg Real Yield. I'm Jonathan Ferro, and let's get you an update on what's coming up next week. Coming up over the next week, we wait to see what's of course going to happen in Catalan with the government, the parliament there on Monday. We'll have some minutes from the FOMC, the IMF World Bank meeting, bank earnings and US economic data, including CPI and retail sales. Plus, the President of the United States, Donald Trump, may give a speech regarding his decision on the Iranian nuclear deal. The President of the United States, of course, made waves in the bond market this week when he said Puerto Rico's debt should be wiped out. I want to bring back in Oksana Aronov from JPMorgan Asset Management, George Goncalves from Nomura Securities International, and Luke Hickmore at Aberdeen Standard Investments. And guys, I can put the general obligation bond of Puerto Rico up on the screen, and we can just see the damage that those comments from the President of the United States did to a bond that had already been absolutely battered. We dropped into the low 30s. I believe we trade right now at about 38 cents on the dollar. George, we're now having this ugly conversation, of course, as we have been with this debt for a while, of the recovery rate. How do you look at a situation like Puerto Rico and try and work out the recovery rate of a bond like that?
So we're not a muni finance shop, so we don't really look at the muni side of things. But I do think that there's concerns around recoveries, and I think it's obviously this is not just true for this one situation, but I think in general across the muni markets, people are just concerned around pension obligations and like the long-term viability of certain aspects of the muni market.
Oksana?
I mean, you've got flight, people are leaving the region now. So if you think about a GO and you think about the fact that it is usually supported by the taxing power of the local authorities, well, that taxing power must be, getting reduced by the minute if you don't have as many people in the region. So, but bringing it back to sort of portfolios, and because, Puerto Rico has been a favorite of high yield muni investors for quite some time. And what we have said, we've generally stayed away from very risky high yield areas of the muni market. And the reasons has been, this is an interesting kind of illustration of the reason, which is that when you're in that part of the market, you're really dependent on a couple of players for liquidity. Yeah. And this is, an extreme illustration of this, but there is no liquidity in this position, and that's kind of the general problem with the high yield muni market.
In terms of wiping out the debt, it was the first time since the inauguration that I've seen Larry Summers agree with the President of the United States, and he said, I agree with the President of the United States, the debt needs to be wiped down. And Luke Hickmore, I just wonder how you're thinking about this situation currently right now. Some reporting here at Bloomberg, it's a population the size of Connecticut, it's an economy the size of Nebraska, and a debt load that's bigger than any single state in the United States, with the exception of New York, California, and Massachusetts. It's a tough situation. And how do you address it? How do you restructure the problems in Puerto Rico, Luke?
And even if you deal with the 73 billion of muni debt, how do you deal with the 50 billion of pension deficit that's in there in the background as well? This is going to rumble on for a long time. 40-odd% of these general obligation bonds are owned by you and me and people individually around the USA. I haven't got any, to be fair. The triple tax benefits of owning these bonds has been really attractive for people for years. So who do you want to punish? It's not the big banks that Donald Trump was talking about. It's your normal pensioners, it's your savers that you can punish. So it's an intractable position. I honestly don't know how you get out of it. Guys, it doesn't feel like the US Treasury can take this obligation on.
It doesn't look like it at all. We're going to wrap things up and we're going to get to the rapid fire round now, where we put together the last 25 minutes of the programme or so and look ahead to the next week as well. Guys, one question, short answers if you can. Have we seen the 2017 low for the 10-year yield, yes or no? Beginning with you, Oksana.
Yes.
George.
Yes.
Luke.
Yes.
There we go. Next Fed chair, pick one. Yellen, Warsh, Cohen or Powell? Oksana.
Warsh.
George.
Feels Warsh.
Luke.
Kevin Warsh.
I'm surprised at the consensus around Kevin Warsh here. OK, guys, final question.
We're not making it fun for you.
Here's one that will be fun and difficult because you've got no choice. You have to pick one of these. Catalonia or Spain of a similar maturity. I'm going to pick out 2020. I can tell you the spread is about 300 basis points. Which one do you want to hold through to 2020? Catalonia or Spain? Oksana.
Not touching that one with a knife.
George.
I'm offline on that one too.
Come on, Luke, you've got to give me one.
You'd have to own Spain. If you had to own one of them, you'd have to own Spain.
There we go, guys. Really appreciate your time. Oksana Aronov from JPMorgan Asset Management, staying out of trouble alongside George Goncalves from Nomura Securities International and Luke Hickmore at Aberdeen Standard Investments. From New York, that does it for us. We'll see you next Friday at 12 New York time, 5 p.m. in London. Until next time, have a great weekend. This is Bloomberg Real Yield.